first thing I'm going to say is, I'm sure you're all aware that in Excel and Google Sheets, there's a random number generator. It's just equals RAND, open close brackets. And that's going to give you a random number between 0 and 1. It's really useful for generating those random numbers, but we are going to use it, but maybe not in the way that you think. So if I scroll to the right over here, you can see what I've got is just a table of euro dollar end of day closing prices from yesterday going back to, where does this go? It goes back to the 1st of January 2022. So what I'm interested in is, instead of just a completely random price for tomorrow, I'm interested in the price movement from one day to the next. So we call those the daily returns. So, and I don't want to just make the daily return random. I'd like to take some of the feel from the real market. So what I'm going to do is I'm going to look at the log returns from the market, and we did this last time in session 1 with the value at risk piece. So very simply, in Excel or in Google Sheets, it's equals ln, and then you're going to take the most recent date divided by the previous date, and you're just going to drag that down to the bottom. And there we get a daily log return. Switching over to this side of the sheet, I'm going to take the mean, so it's just the average, and the standard deviation, SDDev, of the returns. So it's the returns, not the prices. And that's going to give me the daily average return and the daily volatility number, the standard deviation number. This, by the way, equates to an annualized vol of 9.38%. So it sounds about right, doesn't it? So now we've got the mean and the standard deviation. How do we start to prepare the random daily changes? So we'll just scroll down a touch, and you can see this is our chart here. I can refresh that, and it's going to give me nice new random pathways. So starting with today's date, the 27th of July, you can put any number in here. I've used Google's Google Finance function to bring me the current euro dollar spot price, so 110.31-ish. In order to get the next return, I'm going to use the norm inv, the norm inv function. And this is basically going to bring me the number that corresponds to a predetermined probability mean and standard deviation from the normal distribution curve. So how do we do it? Relatively simply, multiply the previous day exchange rate by 1 plus, and then there's our random price change. So in order to do that, we're going to randomize the probability, and then we're going to use the actual log returns mean and the actual log returns standard deviation, and then just drag it down. So there's the formula. Again, I can give this to anybody after the call. It's absolutely fine. And that, once we refresh it, gives us these nice random price changes per day. And it looks like a real market chart, doesn't it? Because it's exhibiting similar levels of volatility on an intraday basis than the actual market has in the past. And I've put here a couple of ideas. Well, what about a volatility input? And what about drift? So here's some ideas for the future if you're doing this. Well, maybe you want to simulate a lower volatility. So I could just overwrite this with 0.4, and I'm going to get a lower vol, or I could put 0.7, I'm going to get a higher vol. So I can put in my own volatility numbers if I want to, and then drift. So what about if we think the market's going to drift one way? So we can compute that as well. So that's all well and good, and you're probably on the call thinking that's very nice, and it's cool that it changes, but what am I going to do with it? Well, first thing, it's not necessarily where the rate gets to. I've put it on the chart here. It's not the destination, but it's the journey that we're really interested in, because it's that random journey through time that we can use to measure the effectiveness of a potential hedging program. And in fact, we can do this. If we can do it once, we can do it lots of times. So here's 25 random walks, and we can have Excel or Google Sheets do this for any number really. I mean, it probably wouldn't like doing more than 100 or so. I wouldn't have thought. But to answer the question, what's the point? Well, let's say we've got some US dollars to buy. So we're a euro dollar business, and we have a monthly requirement of $1 million to purchase, and we've got a relatively simple 3-month layered hedging program where we just hedge 100% for the first month over here, 75% for month 2 and 50% for month 3. I can change these if I want to. It's 25, but I'll leave them as they were. So here's our hedging program. You can see that. I'll just zoom in a touch. There we go. There's our hedging program we can see for each of the months. And then we can use this to say, well, is this the right strategy for us? How would we react if? And we can consider the approach to our pricing. So if I scroll down the sheet, we can see on this chart, there's our US dollar forecast in red. Then we've got the blue of the spot line. This is what the spot rate's done, according to the chart over here. And then we've got the yellow of our realized exchange rate. So what would we have actually achieved by taking this approach? And we can rerun the numbers. So we can see in this instance, it looks like the market's moving higher. So the layered hedging program is going to exhibit a smoother profile, lower volatility, but it's going to lag the market. So maybe we could ask ourselves, well, if the market went from a low of about, what's this, 1.08 all the way up to 136, how's that going to affect our pricing? What's our competition going to be doing? Are our customers going to be phoning us up, asking us for discounts? So if we had a long-term hedge, then that might very well put us at a competitive disadvantage. So equally, if the market were to go, let's try and get one going down. There we go, a hump in the middle. So we can see we're going to participate with that rise, but relatively a little bit lagged and with some smoothing. And then we're not going to see this very sharp, steep fall until a couple of months later with some smoothing. So this is, for me, the random walk analysis is very useful for how would we react if. It's the qualitative stuff, again, that I mentioned. And you can sit around the table with your decision makers in the business, and you can pull up 2 or 3 of these, and you could say, well, what would we do if? How would the market react if this was the case? So hope you find that useful. This is the sort of science behind it. That's the point of these sessions.